Ladies and gentlemen, this is the grey metal. What you're about to see is not hype, it's not speculation, and it's definitely not normal. Silver just pushed above $109 per ounce, and it happened when most people weren't even watching. This was a thin liquidity off-session move that occurred in the electronic futures market during hours when retail traders were asleep. And historically, these are the exact type of moves that come before something breaks in the financial system. Stay with me for the next 12 minutes, because what I'm about to show you could change how you think about silver, commodities, and the stability of our current market structure. Before we dive in, let me be crystal clear about something. I do not sell investments. I do not offer paid signals. I will never ask for your money or push you toward any specific trade. My only goal here is to help you understand what the market is actually telling you, before the mainstream headlines catch up, before the talking heads on financial television spin their narratives, and before most people even realize what happened. This channel exists to cut through the noise and give you the raw data, the context, and the analysis you need to make your own informed decisions. So let's get into it. Silver surged to $109 per ounce on the electronic futures market. Let me emphasize that again. The electronic futures market, not during the New York pit session when everyone's watching, not with full liquidity and normal trading volume. This move occurred during off hours on the CME's Globex platform, when most retail traders weren't even at their screens. The timestamp matters, the venue matters, and the speed of the move matters. We're talking about a multi-dollar surge in a commodity that typically grinds higher or lower over days and weeks, not hours. And it happened in an environment where price discovery is limited, where order books are thinner, and where a single large order can move the market significantly. When you see price action this aggressive in thin conditions, it tells us one critical thing. Someone needed exposure immediately, and they were willing to pay whatever it took to get it. That's not normal profit-seeking behavior. That's urgency, that's fear, or that's positioning for something bigger that hasn't been publicly disclosed yet. Let's talk about why overnight moves on Globex are fundamentally different from regular session trading. The CME Globex platform is where electronic trading happens outside of traditional pit hours. During these sessions, the market is dominated by institutional players, foreign buyers operating in different time zones, and algorithmic trading systems running on autopilot. Retail participation drops significantly, market makers pull back their quotes, and overall liquidity, the ease with which you can buy or sell without moving price, becomes much thinner. In normal circumstances, this means prices should be more stable, not less. Thin liquidity environments typically see smaller moves because there aren't enough participants to drive big swings, so when silver jumps multiple dollars during these hours, it's actually more significant than a similar move during regular trading. It signals urgency, not noise. It suggests that someone with serious capital needed to establish a position right then and there, regardless of cost. And here's the uncomfortable truth. When big money moves this aggressively in the shadows, it's often because they know something the rest of the market doesn't yet understand. Now we need to address the elephant in the room, the fundamental structure of the silver market itself. The vast majority of silver trading happens through paper contracts, not physical metal. We're talking about futures contracts, options, ETFs, and various derivatives that represent silver on paper, but never actually involve the metal changing hands. Very few participants in the futures market ever intend to take delivery of physical silver. They're speculating on price movements, hedging other positions, or running algorithmic strategies. The contract gets closed before expiration, and the transaction settles in cash. This system works smoothly when everyone agrees that paper silver and physical silver are interchangeable, when the price discovery mechanism accurately reflects the underlying physical reality. But here's where it gets interesting. When physical demand starts to tighten, when industrial users actually need the metal, when sovereign buyers start accumulating strategic reserves, the paper system begins to show stress. Because paper contracts can be created almost infinitely, physical silver cannot. And moves like this $109 spike suggest that the paper price may be lagging significantly behind physical reality. It suggests that the premium someone is willing to pay for actual deliverable metal is starting to diverge from the futures price that gets quoted on financial news. This divergence doesn't resolve peacefully, it resolves through violent repricing events. Let's zoom out and look at the structural supply situation, because this is where the real story lives. Over the past 18 months, physical silver premiums in the US market have remained stubbornly elevated. If you try to buy physical silver from a dealer right now, you're paying significant premiums over spot price. Why? Because dealers are reporting ongoing sourcing issues, mints around the world are backlogged. The US Mint has periodically suspended sales of silver eagles due to insufficient supply of blanks. The Royal Canadian Mint has faced similar issues. These aren't temporary disruptions, they're persistent symptoms of a supply chain under stress. Meanwhile, industrial demand continues to accelerate across multiple sectors. Solar panel manufacturing is consuming record amounts of silver as countries race to meet renewable energy targets. Every solar panel requires silver paste for its photovoltaic cells, and there's no economical substitute that matches silver's performance. Electric vehicles use significantly more silver than traditional cars, in batteries, in charging infrastructure, in the electrical systems themselves. Semiconductor fabrication relies on silver for everything from bonding wires to conductive pastes. As chip manufacturing expands, particularly with reshoring efforts in the US, silver consumption rises proportionally. Defense and military applications are experiencing renewed demand as geopolitical tensions escalate. Advanced weapon systems, communications equipment, radar systems, all silver-intensive. This is not speculative future demand. This is happening right now. Production facilities are operating, purchase orders are being filled, and every single one of these applications requires physical delivery of actual metal. Now let's look at what's happening with available inventories, because this is where theory meets reality. COMEX registered inventories, that's silver that's actually available for immediate delivery against futures contracts, remain near historical lows. We're not talking about a temporary drawdown. We're talking about a multi-year trend of declining available stocks. At the same time, open interest in silver futures contracts stays elevated. That means there are a lot of claims on silver that could theoretically demand delivery. Now, in normal times, this imbalance doesn't matter, because most contracts settle in cash, but we're not in normal times anymore. When physical premiums are elevated, when industrial users are scrambling for supply, when geopolitical tensions make strategic stockpiling attractive, the probability of delivery demands increases. And here's the mathematical reality. If even a small percentage of open interest holders suddenly demand physical delivery, the system doesn't have enough registered inventory to satisfy those claims. What happens then? The system doesn't adjust slowly and smoothly. It gaps. Hard. We've seen this dynamic play out in other commodity markets. When the paper system gets too disconnected from physical reality, the reconciliation happens fast and violently. Prices don't trend higher gradually. They spike in ways that seem irrational until you understand the mechanics underneath. This $109 move might be the market's way of sending up a flare, signaling that the imbalance is reaching critical levels. And just to make things more interesting, we need to overlay the geopolitical dimension onto this already unstable foundation. China has already restricted exports of gallium, germanium, and other critical materials that are essential for high-tech manufacturing. They've demonstrated a willingness to weaponize access to strategic resources. The United States is aggressively reshoring manufacturing capacity through massive legislative packages. The CHIPS Act, the Inflation Reduction Act, various infrastructure bills. Every one of these initiatives is designed to bring production back to American soil. And guess what every single one of those supply chains has in common? They're silver-intensive. Semiconductor fabs require silver. Solar panel production requires silver. EV battery production and charging infrastructure require silver. Defense manufacturing requires silver. So we have a situation where demand is being hardwired into federal policy, mandated by law, subsidized by hundreds of billions of dollars in government spending. This isn't optional demand that fluctuates with economic cycles. This is structural, non-negotiable demand that's locked in for years. Meanwhile, primary silver production comes from mines that take years to develop. Supply doesn't respond quickly to price signals. Even if silver hits $150 or $200, it won't materially increase mine output for several years. We're watching a collision in slow motion between inflexible supply and policy-driven demand, and markets don't handle these imbalances gracefully. Now, in the interest of intellectual honesty, let's address the bear case. Because volatility cuts both ways, and I'm not here to sell you a fairy tale. A thin liquidity spike can retrace just as quickly as it appeared. When regular trading sessions open, when more participants enter the market, we could absolutely see profit-taking that pushes price back down. We've seen sharp silver moves fade before. In 2011, silver spiked to nearly $50 before collapsing back to the 20s. In early 2021, we saw a Reddit-fueled squeeze attempt that faded within weeks. So no, this is not a guarantee of straight-line upside. Anyone telling you that silver is definitely going to $150 or $200 or whatever number they're promoting is either lying or delusional. Markets are complex. They're influenced by countless variables: central bank policy, the US, dollar strength, real interest rates, industrial production data, sentiment shifts. All of these factors can and will impact silver prices in unpredictable ways. A single overnight spike does not constitute a trend. It could be an anomaly. It could be a fat finger trade. It could be unwound within days. But here's what we need to focus on. What doesn't fade is the structural problem. Annual silver deficits, where consumption exceeds new mine production, have been significant for years. The World Silver Survey and other authoritative sources have documented this consistently. Those deficits have been filled by drawing down above-ground inventories. But above-ground inventories are not infinite. At some point, the buffer disappears. And when buffers disappear in commodity markets, prices don't adjust gently through smooth, predictable trends. They reprice violently through spikes that catch everyone off guard. Think about what happened with natural gas in Europe. Think about what happened with lumber during COVID. Think about the nickel short squeeze on the London Metal Exchange. When supply and demand fundamentals reach breaking points, the market's response is chaos, not calm. This $109 move might just be an early tremor, or it might be the beginning of a genuine repricing event. We don't know yet, but ignoring it because it happened overnight, or dismissing it as just volatility, would be a mistake. This move above $109 is not just a number on a chart, it's a signal that stress is building between paper pricing mechanisms and physical availability. It's a signal that the gap between what futures traders think silver is worth and what industrial users are willing to pay for immediate delivery is widening. And historically, when that gap becomes unsustainable, the snapback is fast and brutal. We don't yet know if this $109 level holds through regular trading hours. We don't know how institutions will respond when they see what happened overnight. We don't know if this triggers additional buying or if it gets faded into a non-event. What we do know is this: volatility is rising, liquidity is thinning, and silver is no longer behaving like a calm industrial commodity quietly tracking supply and demand fundamentals. Something is shifting beneath the surface. So here's what I recommend. Verify the data yourself. Don't take my word for it. Watch COMEX inventory reports. Track physical premiums at major dealers. Monitor industrial demand trends. Pay attention to geopolitical developments around critical materials. Stay rational, stay informed, and don't ignore the warning signs just because they appeared in the middle of the night when nobody was watching. This is the grey metal. I'll see you in the next one.